What up, people? Top of the hour. That means 1 o'clock on the East Coast. Guy Adami here, always joined by Dan Nathan. Tuesday, May 18th. You're watching Market Call. You knew that. Today's Market Call brought to you by CME Group, Dan. That's, in fact, where risk meets opportunity. And I got to tell you something. Of all the taglines, I dig that. Somebody really came up with a winner there. And we are powered by Open Exchange. Follow them at Open Exchange TV on the Twitter. A lot of these things are coming to pass just the way you said they would a week or so ago in terms of the broader market. Here we are, a decent rally underway off that Thursday bottoming or seemingly short-term bottoming formation. Dan.
Well, Guy, what do you make of it when they call it risk on? Today's a risk on day. What do you like to make of that terminology? You like it? You don't like it? You indifferent to it?
What do you think I think of something
I think
like
you hate
that?
it. I think you absolutely hate it. Okay,
Yeah.
so today is a risk
Hey,
on.
Judge, it's risk on today because we were buying the dips and selling the rips. Bang!
Bang. Bang. You didn't mention that that little I had a head nod to the heat seeker
No, I heard
last
it.
night.
Yeah, I did hear it.
I
gave
just
it
want to
the-
make sure I
the
fired up
appropriate-
the heat seeker here. All right, well here, let's talk about this risk on market that we have right here. I mean, listen, I think you and we make this point again and again and again on Market Call, okay? So right now we are particularly pessimistic about the outlook for the Fed to deliver a soft landing, right? For the excesses of, you would say 20 years of very easy monetary policy, but specifically the last 2 years where you've said the mistake, the policy mistake was made long ago, and whether that's a year and a half ago or whether it's 6 months ago, whatever it is, or 20 years ago, that's fine here. But the idea that the S&P 500 down 20% at its lows last Wednesday or Thursday is going to encapsulate all of that at a time where we have 40-year high inflation, we have 40-year low unemployment, right? We have yields going up precipitously over the last year or so. We have a raging dollar. I mean, the list goes on and on and on, right? You and I are not in that camp. So what do we do with a day like today or a multiple day rally? You have to respect them. You have to let them breathe a little bit. I brought a chart of the S&P futures here, Guy, and I just need you to look at this year to date here, and I want to get your take. I mean, when you look at these legs lower that we've had 3 significant legs lower. They keep getting bigger, right? Now, we've had some really big bounces, the kind of sell the rumor, buy the news after the March Fed meeting where we had that, 11% rally. But then since then, the peak to trough decline was about 16%. So we're in the midst of a little bounce here. We've had 2 little bounces over the last month. This is a really important kind of chart to get your arms around because, I don't know, to my eye, Guy, maybe 4,200, 4,300 in the S&P futures, that's where you get some resistance here?
Agreed. And if you listen, we could draw a trend line down from those March highs, and you would find that resistance would come in the form of exactly what you just laid out, 4,200 or so in the futures. And listen, in terms of what our views are, we were overwhelmingly bearish into last week when everybody seemingly got bearish at the same time on Wednesday, specifically Thursday. That seemed to be a logical point to say, hey, wait a second, maybe everybody's on one side of the boat. No, by the way, we had talked about 3750 being the support level in the S&P 500. Thursday's low was 3858, and we talked about it being close enough for government work on the show that night, Fast Money. I said, look, you could probably see another 4 or 5% bounce from here. And that's what we're in the midst of. I think we are 6% or so off those lows we made intraday on Thursday. I think we have a few more percent to go. It's going to be fascinating to see how today closes. But as you mentioned earlier, I'll say it in my terms, the biggest rallies, the most mind-numbing, rip-your-face-off rallies take place in bear markets. And quite frankly, I think that's what we find ourselves in, Dan.
Yeah, I mean, listen, you and I, and I'm going to say to any of our listeners, viewers here right now, check out our On the Tape podcast. Danny Moses and I are co-host. We interviewed Guy Adami. We got to where he came from, how he came into the business. And one of the reasons I want to say, so that's going to drop on Friday morning. So check that out in the podcast stores, people. It's called On the Tape. It was an excellent conversation. We just taped it yesterday afternoon. But the reason I bring that up, Guy, is that you and I both came into the markets, me 25 years ago, you a little more than that in the late 80s. And we were traders. We were looking at intraday moves. We were looking at the sort of catalysts that might move, things, whatever. You were trading commodities back then. I was trading stocks. But right now, we have a trader's mindset, but we're also speaking, we know, to investors. We know that most, investors who want to trade too frequently are going to get chopped up here, but it's important to kind of identify the sorts of levels and where you might see sentiment shifts. And I think that's what we're talking about here a little bit. Let's look at the 1.5-year chart of the S&P futures, though, Guy. When you think about this one here, look at that to the penny almost of that late March 2021 low where we got down to, you just mentioned you were looking for 37.50. It came maybe sooner than you thought it might. You have not gone away from that thought process here. Like if you think about where we were at the start of January 2021, we were just above 3,600. And I think you think that if we do go to your 37.50, there's a good chance that we overshoot to the downside.
Yeah, and that comes in the form of probably 34.50, 3,500 without question. We've seen overshoots to the upside. My sense is you will see it here. But you look at that chart since December, and what you have is a series of lower lows and lower highs. And I just think that's what the formation we're in the midst of now. We obviously troughed last week. I think we're bouncing here. I don't think this bounce is going to be more than the magnitude of potentially 4,200, as you outlined earlier in terms of the S&P. I'd actually be surprised if it got there. But that sort of lines up with the math we did last week. So here we are. And you're right to point out the difference. There is a fundamental difference between trading and investing. One of the things that I've said for years, and I believe this, I think you have to pick which one you are. I don't think you can be both, because what winds up happening is a trade that goes awry winds up being an investment, which never works. An investment which goes well, very quickly winds up becoming a trade, which also never works. It's sort of that push me, pull you for you Dr. Doolittle fans. So just make sure you know what hat you're wearing and act accordingly, Dan.
All right. Well, I'm going to put my options hat on here for a second, Guy.
Well, I like that, too. Hats are fun. By the way, not to interrupt you, I apologize, but obviously the hat that everybody seems to be wearing right now, for good reason, would be the hat of the New York Yankees. They play in the Bronx, New York, currently atop Major League Baseball in terms of best records, playing at a 74% winning percentage, which is just ridiculous. Do that math, Dan, and you have a 122 win team. Back to you.
Yeah, 26-9. Every time I look up, it looks like the Yankees just won. And your Rangers are in the second round here, so we're excited about that. I just wanted to mention that we have, options expiration coming this Friday, and we know we've had a very volatile time. And sometimes when you see big price movements over a short period of time, where there were some strikes, maybe in major indices that you didn't think were in play, that are in play, you could get some volatility into the end of the week. And we have a VIX here, Guy. You and I were just talking about it before we came on. If you look at it from the fall, we've had a series of higher lows here, right? And the highs have all kind of topped out in the high 30s over the last few months or so. So maybe you see a continuation of the stock market rally, okay? And then you see a VIX come back towards that uptrend, which would be around 20. But that's probably where you reload if you think about it here. And I'm just curious, we're going to talk about bond yields in a second, but Guy, thinking about the VIX and its way maybe over the next few trading days, we do have Jerome Powell speaking this afternoon. I know that you are getting all geeked up about it and you're going to want to keep this thing going, but he's speaking to the Wall Street Journal. Rates are moving higher today. And I know that you do not like the sort of bond volatility that we have in yields. We're up like 8 bips today at 2.96 in the 30-year. Look at this year-to-date chart of the S&P versus the 10-year yield. You see that divergence. And one of the things that stocks did not like over the last month and a half was that precipitous move higher in yield from basically 2.4% to 3%. And that's really what got the stock market going lower. Are we going to see any funny business this afternoon, Guy?
Couple things. So I think the rise in yields correlates with the rise in the market. I think, as I've said before, on off days, on selling days in the S&P or the NASDAQ, I think those are days where you find yields go down as we have sort of this flight to quality. Whether justified or not, it doesn't matter. That's what's happening. So in my opinion, nothing's changed fundamentally for yields to go higher other than the fact that the market's now rallied for the last 2.5 or so days. And I think that's what you're seeing. In terms of bond volatility, it's really unprecedented, the type of moves we're seeing. You mentioned 8 basis points today. We've had 15 to 18 basis point days in the 10-year. Doesn't make a lot of sense to me. In terms of the VIX quickly, I'm glad you brought that up because although lower than the recent highs, it's still elevated with a 26 handle. But I think, in my opinion, what you're going to see when the VIX gets down to, and I do think it's going to go down there, 23.5, 24, my sense is that will correlate with the S&P topping out. So low VIX, high S&P, that's when you start taking money off the table. And if you have the temerity to do so, start layering shorts again. So you have to keep a keen eye on the VIX. Not that you're trading it, but just gives you sort of levels as to where you can enter new trades on the short side, I would think.
Yeah, and I agree with that analysis. And so we got a couple things this week to keep our eye out for. One thing I'd say is that when we do see yields moving higher, we've seen high growth tech, high valuation tech get hit really hard. We have the NASDAQ futures from their late March high guy. They went down 23% into their lows late last week. That corresponds with that pretty significant move that we saw in yields in the 30-year, obviously in the 2-year, in the 10-year and in the 2-year. So that was kind of interesting. When you look at the NASDAQ 100 futures, though, man, it doesn't feel like a great bounce right here, guy. And if you're looking at that steep decline, you see that downtrend. So we're going to keep an eye on that. Maybe it's about 1260 or 12,600 or so. But look at that massive resistance level at 13,000. That was the breakdown level from a few weeks ago. It was also where the NDX futures held back in March. And so to me, I think that's a really important one to keep an eye on. Thoughts on the NDX, because I know you and I have been in agreement that we were waiting for the Apple to break 150. It went from 150 to 140. Microsoft gave it up a little bit. Amazon's been a bit of a mess, but Apple is the one only down 16.5% on the year. The other three of the MAGA complex, the Microsoft, Apple, Google, and Amazon, are all down 20% plus.
Well, all you need to know is, Danny Moses, our co-host on the Tape, he was in that movie, The Big Chill, which was fantastic, by the way. The soundtrack was just excellent. But one of the people featured in that book and subsequent movies, a guy named Michael Burry, I mentioned him because it was last summer that he pointed out that he thought the ARK ETF was way too expensive. He was buying puts in that, buying puts in Tesla. Typically, he's early. In that case, he couldn't have been more spot on. I mentioned that because it was in the last couple days that he mentioned he's actually buying puts in Apple. So think about that. Yeah. This is somebody that has the world is his oyster in terms of what he can do. And he thinks one of the best trades right now is to buy Apple puts. Now, look, with that said, maybe he covered them last week when it traded down to 138.80. I don't know. But I'll say this. It's something to actually keep an eye on. And you have to wonder, is that going to be the last shoe to drop? And is that going to what takes the NASDAQ down this next leg lower? I think the answer is yes. I heard a lot of people over the last week and a half saying the right level for Apple to trade down to is somewhere between 115 and 120, which you've never heard people talk like that over the last 5 years in Apple. Now all of a sudden there's this quiet whisper of Apple bears coming out of the woodwork, and we'll see if it comes to fruition. I think it will, and I think it takes the NASDAQ down with it.
Yeah, I'll just say this, real quickly, and you and I, these 13F filings for big fund managers, they pop up all the time, and that was a 13F on Michael Burry from March 31st, right? And we talked about it last night on Fast Money. I mean, the stock went from 150 to 180 in a straight line in that late March rally, and that disclosure was what he did prior to March 31st. So it made a lot of sense to kind of lay that short out into that kind of rip there. And to your point, Guy, once it broke 150, maybe that was probably a good case to cover the short or sell the puts or whatever he had on there. Let's talk a little bit about the underperformance, though, in software. The IGV, it's an ETF that tracks some of the major software names. Adobe is one of the largest. Microsoft's in their Salesforce, and then a bunch of other SaaS names. This thing was down 43%, Guy, at its lows last week versus the NASDAQ 100 that was only down 30%. And you see that massive underperformance. Look at that breakdown at $300 there to new 52-week lows. That was pretty disgusting. If you look at it, the low was 257 just a few trading days ago. So here we are at 276, 300. We're kind of in the middle of that range there. What's your take on high valuation software? Because you and I mentioned it. These are not the small names. These are some of the really big names that were trading at crazy multiple to sales when you think about an Adobe and the market cap that it had and what the multiple to sales it was trading at just a few months ago.
Adobe at 9.5%, Microsoft, Salesforce. I mean, Oracle's in that group as well. Oracle's probably the only one you can justify on valuation, but this is interesting because Karen Feinerman has actually been short this as sort of a proxy hedge for some of her portfolio, and that's worked out really well. But again, just to emphasize, it's not coincidence that this topped out late November, early December, and started heading lower. Obviously, that's around the same time the Fed pivoted, same time that people started to be concerned about valuations. And for many of those names, valuations made sense in a zero interest rate environment. I'm about to sneeze, so I apologize. They don't make excuse me, a lot of sense in the environment that we find ourselves in. But this too will find a bottom. But the move from basically, Dan, I think almost what 450, 448 and change down to 250. I mean, that's a pretty remarkable move in a 6-month period of time.
Yeah, let me ask you this, guy. Are you a bless you or a gesundheit? What do you do? I said bless you, and you have this fine Jesuit education, so I'm assuming that has something to do with it. But is gesundheit, is that like if you're an atheist, is that what you do? You just say gesundheit?
I'm not really sure. Well, I mean, apparently that must be something from the German language. Not being German, I'm not really qualified to answer. I will say I think the genesis of bless you is in a certain era. They thought when you sneezed, your soul was leaving your body, and that's why they would say God.
Well, listen. Well, bless you, guy. I hope your soul.
See what you learned here on.
I see. You almost called it Boomer TV. I saw you do that.
I caught myself.
You did catch yourself.
That's because I do things. Tuesdays and Thursdays are just. A ridiculous amount of content we put out, but please continue.
Hey, listen, it's all differentiated too. All right, let's move to, I think some of the big news today was this retail spending. We had kind of previewed a couple big retail earnings today, but we had a hot retail spending number for April. You've said it again and again. I've heard you probably say it 100 times on Fast Money over the last 10 years. Don't confuse what? Give it to me, guy. Give it to me.
Don't confuse the consumers want to spend, which they will always have, as their ability to spend, which over periods of time, we've seen they've been in position to spend and they're in positions not to spend. And we've seen, listen, just go look in credit card reports. I mean, people are levering up once again. That pendulum swings very quickly. So people spend when they got their checks. They're spending now. And quite frankly, credit's concerned. And if you don't believe me, on a day where the market's up significantly, we don't have a chart, but you can go to your Google machine and check it out. The HYG is actually making another 52-week low, or right around one, lower on the day. So something's amiss. Credit is a concern. And again, that's sort of the foundation of everything. So to bring up the consumer is right. They'll obviously spend, but right now I don't think they're really in a position to do such. And obviously with inflation where it is, I mean, that spending number goes up almost by definition. It's not like they're buying more. It's just what they're buying costs more.
Yeah, well, I mean, the consumer credit data that we got from March, we saw that consumer credit was up $52 billion. That was one of the biggest one-month gains in, I think, decades. And it was also up about 15 or 14.5% year over year. And revolving credit in particular was up 21%. That was about 15 billion of that number. So we definitely want to keep an eye on that. So we had a hot retail number. Couple really different prints today. Walmart, guy, we talked about it yesterday with Carter a little bit, and we know that who the Walmart consumer is. It might be one that is kind of more apt to use credit to maybe buy staples. We had a very disappointing quarter. And for a stock of this size to be down 10% on earnings and guidance, you have to pay attention to this.
Without question, this is the single biggest one-day downside move, I think. Please don't at me, but since 1987 in Walmart. And it's an astronomical move. Now, full disclosure, we talked about it on Market Call yesterday. I actually thought Walmart set up incredibly well into earnings. And I got to tell you something. I don't think it was so much the release as it was some of the concerns they have going forward. Specifically, slower growth in China, because you think about what kind of growth engine that is. So when you ratchet down full-year guidance, obviously inflation is a concern for them as well. They're on razor-thin margins. It all adds up to the move we're seeing today. Now, at a certain point, and it might be today, although there is that 3-day rule out there, I think this thing capitulates to the downside. And we're going to have a huge volume day. I think it's already traded north of 25 million shares. So we'll see if that's a capitulation, but not good. And to your point, when a company the size of this and the importance of a Walmart says what they say, I mean, don't think it's just them. I mean, this is now endemic to the system.
Yeah, and it's interesting. We have two charts here. We have a 1.5-year chart, and you see that kind of 130 level is probably a big level there. But you back it out on a 5-year basis, and you see you got a nearly 2-year consolidation between basically, 130 or so, and maybe somewhere that looks more like 155. We had that recent breakout, but the failure, and that's a pretty bad failed breakout. But I agree with you. I think that you and I have been talking about, well, what's the one thing that needs to capitulate a little bit, and it needs to be consensus estimates for earnings, either for individual companies, which obviously make up the whole. And so to see more companies like Walmart come out and reset the balance of the year, I think that's actually positive. And I would also look, below 130. Maybe this is a name that you want to start to pick at. Home Depot on the flip side, guy, this is one where, you and Carter kind of nailed it yesterday. You're like, listen, when you see a company like Home Depot down about 30% from its recent highs, basically on macro sort of of headwinds, that sort of thing, it's probably a good do to be buying this stock. Here's a 1 year and a half stock. And this is one I think on valuation that also, makes some sense. It's but a lot more attractive, I think, than Walmart, which was trading north of 20 times into the print yesterday. This is probably a market multiple. So you had that move, guy, above 400. It got as high as 420 in the fall, and it's really been acting very poorly, for the last few months. Maybe that number is 250 to the downside, guy. There seems to be a gap there. You back this thing on a 5-year basis. You look at that low from early 2021, that was 250. You also see that breakout level that was about 250 from 2020. Is that a level that makes sense to you?
Well, look, that 285 level, that horizontal green line, that's what we talked about last night on Fast Money. I said this is where I had trouble with at those January, February, back in 2021. It should theoretically be support, and it was. And I got to tell you something. When I saw the earnings release, I'm like, yeah, this actually is winding up exactly what we thought. I think the stock traded north of 310 or right around 310. It's given the entire move and then some back, which is not particularly encouraging. We'll see how the day shakes out and how it ends, but not a particularly good trading. And we say it all the time, good news, bad stock action. I mean, that's, again, all you need to know, because I do think the quarter was okay. Now, maybe, and I'm just saying maybe, obviously don't know, but maybe some of what Walmart said, people are saying, you know what, Home Depot's not going to be, they're not going to be insulated from that, and maybe that's what's going on here. I don't know, but again, good news, bad price action. NG, 285, that level through there, you're looking at that 250 level, like a bullseye, I would imagine, like a magnet. And given the way it's trading today, Dan, I got to tell you something. It feels like we're probably headed there.
Yeah, and listen, again, this has a lot to do with rates and access to credit and all that sort of stuff. And so, to me, obviously, Home Depot has something to do with the home. It is consumer discretionary, but also the housing dynamics where there was a lot of fixer-upper sort of activity during the pandemic. So interesting that they beat and raise. It's interesting to see if that might be the last great quarter, which could set up for some difficult comps going forward. I want to talk rates for a second here, guy. Last night on Fast Money, we had a guy named Joe Zeidel who I think you would say does amazingly thoughtful work. That is a Guy Adami quote about people, strategists that you like a lot. And I like, what do we call him? Jay-Z? I like Jay-Z too.
He was Jay-Z before Jay-Z.
Right. And he's their chief investment strategist at Blackstone. Smart guy. I mean, there's a couple things I just want to talk about as we talk about rates here. So he thinks that the Fed, the consensus right now, we have the CME Fed Watch tool right now showing that a greater than a 75% probability of a 50 basis point hike at the next meeting in June, and then a little less, a 75, a little less that they do 50 in July. And Jay-Z was saying that he thinks that a lot of people are coming around to the thought that maybe they hit those 250 basis point hikes and then they kind of step off a little bit. He thinks that we're going to see more rate hikes in the future. A lot of consensus, or I guess consensus has maybe one hike in 2023, but this is a big but, okay? But he doesn't see unemployment going up meaningfully, and he doesn't see housing coming in meaningfully. And I just don't know how all of those things could be correct. And I'm just curious, because I said I respectfully disagree with that. I think that we are going to, all signs point that unemployment is going higher. We are basically back to the pre-pandemic levels at 3.6%. And anecdotally, we're seeing lots of signs with mortgage rates having doubled the 30-year from basically 275 to 5.5 in just a matter of months, that we're going to see housing slow down. So talk to me about this, and then let's talk about the 10-year yield.
Now, look, all great points by you, and you pushed back last night correctly. What I said was, it's clear people will say that Joe is talking the book of Blackstone, and they'll look at that as a negative. I actually say, yeah, they are talking their book. They become like the largest real estate holders on the planet in terms of what they've accumulated. But that doesn't mean talking their book's a bad thing. They actually believe it. I don't think they're trying to talk it to get things higher. I think they're saying what they believe. To answer the question, yeah, I think unemployment can tick higher, but how much more meaningfully higher? A little bit north of 4%. which would still be sort of the low in terms of the historical levels. And in terms of housing, it really comes down to a supply-demand situation, which I don't think is going to rectify itself anytime soon. Now, the flip side of that coin is affordability's never been worse. Obviously, prices need to come down, but I think his point is those things might they might modify a bit or might come back to some sort of reality, but it doesn't mean the housing market's going to crash. I think what he was basically saying, I'm not trying to put words in his mouth, things might have gotten a little toppy, but it's not going away anytime soon. And I agree with that. Now, we will see, if things do go pear-shaped in terms of the market, inflation continues to be a concern, that sort of flips the switch a little bit. But right now, I understand what he was saying.
Yeah, I mean, listen. So just putting my 2 cents back into it, guy, is that you've been saying even if inflation has peaked, we are going to see pesky and persistent prices, right? And so we have home affordability where it is. We have mortgage rates have gone where they are, right? We have unemployment we know at unsustainable levels, and we're seeing anecdotally lots of high tech companies starting to lay workers off or pull back their ambitions to hire more people. That's going to mean softer wages, right? And so I think if you put all this together with the negative wealth effect from the stock market being down 20% at its lows last week, and if we were to have another leg, there's no way we avoid a slowdown or a softening in housing. So to me, I just don't get that. But let's talk about this 10-year yield, guy. I have a 10-year chart right here. You've been Johnny on the spot with the levels for a very long time now. Here we are. We got up into the danger zone, if you will, north of 3%. We know the last time the S&P went down 20% when we had a 10-year yield above 3% in late 2018. What's your take here on yields? You mentioned just a couple minutes ago, you see a flight to quality and risk off days where you see people buying U.S. Treasuries. That means yields come in. Is that going to be a trade if we continue to have a lot of chop in the markets?
Yeah, I think so. So, I think today, again, to try to explain what's happening, yields to me going higher today makes sense in terms of the market going higher. So the trajectory has been right. But again, if I think this S&P is going to exhaust itself, which I do, in another few percent, I think that's when yields start going back down as you'll see this flight to quality. And, the red lines, the horizontal red lines you drew, that is in fact the danger zone for you Top Gun fans coming out, I believe on the 25th, if I'm not mistaken, which is in fact next week. I will have my ass in a chair somewhere.
Really?
At 10 a.m. Oh,
really?
Absolutely.
Really? Oh my
Without
goodness. When's the last movie that you actually went to a theater to see?
French Connection.
There you go, 1977.
Yeah. Gene Hackman, love Gene Hackman.
Yeah,
Just
Popeye.
All
right,
Popeye Doyle, who actually wound up being a bad guy if you go back and look, but that's neither here nor there.
I will tell you this, that I have an obsession. I've lived in New York since 1996, New York City. I have an obsession with those 70s movies, whether it be Serpico, whether it be Dog Day Afternoon.
The 7-Ups.
That took place in the New York City. The city was so gritty, and it was like a character in all those movies. I loved them all, man. All right, one last one here, guy. Last week on Market Call, and I almost fell out of my chair a little bit. You talked about
the banks.
Yeah, you were warming up to the banks, and we talked about it again. I just want to pull up this XLF chart. We know it's kind of funky. The largest holding in there is Berkshire Hathaway here, but look at that thing, guy. That's a 5-year chart. You see where that pulled back to? Pulled back to that trend line of those highs that we've seen over the last 5 years. Obviously, the 2019 high and the 2017 high. What's your take on banks here? Warren Buffett obviously said in the 13Fs, he took a very large stake in Citigroup. That's been a name that you've liked on valuation, but you were cautious given their exposure possibly to Russia and Europe in general. Quick take on the banks before we get
Citibank, which traded down almost, I think, 74% of tangible book, which is just trough valuations. I understand what he's looking at there. But the one we've mentioned a number of times, JP Morgan, which was north of 2.6 times tangible book at its zenith, got back to sort of more normal levels when it traded down, I think 116 or so, got down to almost 1.7 times tangible book. I mentioned that because that's a reasonable valuation, and that's a valuation where things can start to build from. So I just started looking at the landscape, looking at the sell-off in a lot of the banks and the XLF, and said, this might be a decent opportunity for a trade. Now, maybe I was a day or two early, but it's starting to come to fruition. And my sense is, you're going to start seeing people upgrade some of these bank names. Again, I'm not saying these are long-term holds or anything like that, but for a trade, you could see 15, 20% move in these banks very easily. You've seen it before, and I think you're on the precipice of seeing it again.
Yeah, fair enough. I mean, listen, sentiment couldn't be worse, right? And they were one of the first groups this year in 2020 or 2022 to act particularly poorly before, a lot of like mega cap tech stocks started going down. All right, listen, guy, I know we got to get out of here because you got to get in the proper seat to take in that entire Jerome Powell, conversation that's going to happen at 2:00 here. I know you're kind of breathless with anticipation here, buddy.
I mean, another zero. I'm sure he's a lovely guy. I'm sure they're all lovely individuals. But I have no
time,
no affection whatsoever for any of these Fed officials. I have a deep amount of affection for you.
Thank
for
you,
Brendan, for Stu Gotts from Boston, of course, for Amanda Diaz, who just kills it day in and day out.
Yes,
and I have a tremendous amount of affection for everybody that's been tuning in each and every day for Market Call, Dan Nathan. That's what I have affection for. I also try to be respectful of the clock. And at 1:31, I will say, that's it for Market Call on this Tuesday, May 18th. Guy Adami, Dan Nathan, we're going to catch you tomorrow at 1 p.m. I think Carter Braxton Worth will be joining us. I want to thank CME Group, which kills it, where risk meets opportunity. And check out our friends at Open Exchange. They're powering us. They're at Open Exchange TV on the Twitter later. Oh, before we get out of here, Mets playing a twin bill today at Shea. They drop them both. Hasta la vista.
Yeah.